When most people think about investing their cash, they think about the downside. They think about risk. But a second critical factor comes into play, which is returns. In other words, what you get back in terms of dividends and gains needs to outpace inflation and taxes if you are to maintain your purchasing power. If you hold cash in a high inflation environment, you lose. That's just a result of simple mathematics, as inflation means cash gradually loses its value in purchasing power. It's clear that holding too much cash can be a losing strategy. But what should investors do instead? Here are 4 alternatives that will give you a better chance to generate gains and outpace that pesky inflation. As always, however, do note that this is not financial advice, as this is merely for educational and entertainment purposes. Now, let's get into it. Number 1. Stocks and shares via ETFs. As an investment vehicle, individual stocks are susceptible to booms and busts. However, investing in equity exchange-traded funds, or ETFs, is potentially a better way to beat inflation. ETFs are baskets of equity or stock assets that trade on an exchange like a stock. The value of an equity ETF rises and falls with the underlying value of the shares in the basket. When inflation goes up, the prices of the assets in the basket hopefully go up as well, and the ETF share price goes up along with it. If the ETF holds shares of companies that typically benefit from higher inflation, such as consumer goods or energy, the value of the ETF can outpace inflation and generate good returns. This makes ETFs a great way to protect your purchasing power from inflation. Equity investing in general can help people become financially better off, and supports long-term financial goals. The average annual return of the S&P 500, since its inception over 60 years ago, has been just over 10%. It's typically higher than inflation, so investors holding S&P 500 stocks have had their purchasing power grow, even with inflation factored in. Of course, there are always risks associated with equity investing. However, if you set a limit to your investments, for example, 30% or less of your portfolio, and stick to it, equity investing can be very worthwhile. And of course, diversifying via ETFs is a great way to do it, even if you aren't new to the world of investing. Their low-cost nature can really help in terms of maximizing your net returns. To start off with, try going with an ETF with an expense ratio of less than 0.5% per year, from well-known ETF providers, such as Invesco or Vanguard. This will limit your costs and the risk associated with an investment manager picking stocks that underperform. Number 2. Real estate. Investing in real estate is a great way to beat inflation. When you invest in real estate, you are buying a physical asset that should go up in value over time. Investing in real estate is a great way to build wealth in the long run. It is a physical asset that should give you some capital appreciation, while also generating cash flow in the form of rental income. Of course, this isn't a guaranteed thing. You do need to do a bit of homework to ensure that the property you are acquiring is in a decent location, so that there is demand from renters. Having a good credit score helps a lot too, when it comes to taking out a mortgage or a home loan to finance it. However, there are other ways to invest in real estate, without actually taking ownership of the physical property. Real estate investment trusts, are popularly known as REITs, are a great way to invest in property in a fast and more straightforward way. Think of these as mutual funds or ETFs that invest in real estate, rather than stocks or bonds. The other major advantage of REITs are that you can get the opportunity to invest in some classes of real estate that you ordinarily wouldn't. For example, industrial properties such as warehouses and manufacturing plants cost tens or even hundreds of millions to buy, and aren't exactly accessible to the average investor, like you or me. However, by investing in an industrial real estate REIT such as the Prologis REIT, you can get a slice of this market. Of course, you may think that the Prologis REIT might be a bit overvalued right now. But there are plenty of others out there for you to consider adding to your portfolio. Number 3. Government or municipal bonds. One potential way to keep pace with inflation is by investing in government or municipal bonds, instead of keeping too much cash on hand. Bonds are a great way to grow your money, while also getting security and peace of mind. Plus, in the US, they are sometimes fully or partially exempt from taxes, which can help you keep more of your money in your pocket. Similar to stocks though, picking the right bonds to buy can be tricky from a risk and return perspective. The solution is the same. Look at bond funds or bond ETFs, rather than individual bonds. These give you diversification, while still sticking to the government or municipal sector. While it's true that they do charge fees, these can be pretty low, especially in the case of ETFs. Let's take a quick look at a couple of benefits of holding bond funds over keeping cash in hand. You can diversify for better risk-adjusted returns. As we mentioned earlier, when you invest in a bond fund, you are diversifying your risk across a large group of issuers. When you hold individual bonds, the fortunes of just one issuer can make or break the value of your entire bond portfolio. But when you put your money in a bond fund, one bad investment won't make much of a difference because it's spread across many issuers. Bond funds also offer greater portfolio stability. Because they provide greater diversification, bond funds might have lower monthly returns than individual bonds, but can offer similar final values over time. In other words, while it's harder to get excited about modest monthly gains with a bond fund, you still get the security and peace of mind that comes with holding a proven asset like bonds, and you won't have to worry as much if markets go through a rough patch. That's a good trade-off in our book. Number 4. Cryptocurrencies. Another more unconventional way to beat inflation is by investing in crypto instead of keeping cash. Cryptocurrencies are designed to be inflation-resistant, though their value is subject to fluctuation. However, crypto can be a good hedge against inflation due to their very nature. Cryptocurrencies are not directly subject to inflationary pressures, in the same way that fiat currencies like the US dollar or the euro are. This is because their supply has been designed from the ground up to be limited. There will only ever be 21 million Bitcoin, for example. This means that cryptocurrencies are less likely to be affected by inflationary policies than fiat currencies. It's impossible for someone to decide to just create a new supply of Bitcoin out of thin air, whereas we've seen in the past decade or two that it's very possible for countries and central banks to print money and increase the money supply tremendously. This, of course, is one of the main drivers behind inflation. If there's more money floating around without a corresponding increase in goods and services, the law of supply and demand tells us that it will simply be worth less. There are a few different ways you can invest in cryptocurrency. One way is to buy digital currency directly from exchanges, which is probably the way that most of us think of. This is a relatively simple way of buying crypto, by opening an account at one of the popular exchanges, such as Coinbase or Binance. You can then use the crypto wallet provided by the exchange, or get one of the popular open-source crypto wallets like MetaMask, to store your crypto in. A slightly more straight-laced way of buying crypto is by investing in mutual funds or ETFs. Similar to what we talked about earlier with equity and bond funds, this has the added benefit of diversification across multiple types of cryptocurrencies, which can make things more palatable from a risk standpoint. It can sometimes be stomach-churning to see individual crypto prices fluctuate if you watch them daily. Another more indirect way is to invest in blockchain technology companies that are creating or enabling the infrastructure for the cryptocurrency industry. These include some of the better-known hardware manufacturers, such as IBM, NVIDIA and AMD, along with payment processors such as PayPal, that are getting more and more into the crypto transaction space. But you can think of those as partly equity investments, rather than just crypto per se. Keeping cash is always an option, but it shouldn't be the main asset type in your investment portfolio. If you're holding on to cash just because it makes you feel safe or you're afraid of losing it, the hard truth is that inflation is already doing that. It pays to look at alternates, so that your wealth keeps growing. Check out this video next for more alternative investment ideas.